Ladies and gentlemen, welcome to the Now Selling podcast. I am Chip McCabe, and it is a pleasure to welcome you here today for a very exciting, I must say, edition of the podcast today. We have Callan Wayne-Bowles with us today. And Callan, before I say an official welcome to you, do you know how we start the Now Selling podcast?
I don't, Chip.
Well, how we start it is with the big book of introductions, and I've taken your profile here from your online page. So we'll just do a very quick introduction. You can see if this still rings true. So Callan joins us today. He is from the former home loan shop, now Squirrel Mortgages, here in Wellington, and he is one of the original, the OGs, directors at a home loan shop. That would have been with Cookie, Big Greg, a couple of the others.
Yes, yep. Sloan McPhee, Bernie Upton, Martin Duncan back in the day, yeah.
All fantastic New Zealanders as well. Yeah. It says here you're the most successful poker player out of the team, but would Greg beg to differ on that one?
Officially, yeah, it depends how you measure it, but yeah, I'll claim it.
We'll take it away. Now, it says here you hold a degree in accountancy, commercial law from Victoria University, and prior to joining the home loan shop, you spent 12 years working for the major banks. Go on, impress us. Ring a few of those banks off. Who did you work for?
All with ANZ, yeah, and National Bank when both brands under the same company. So
12 years in the industry there. So you've got a wealth of knowledge, it says here, of the finance industry and a huge number of repeat clients, which I might add, some of work here at Ray White Kemeys Brothers as well. So we're very fortunate to have you in here. And of course, it says here that the number of repeat clients and referrals you receive is a testament to your reputation as a leading mortgage advisor in Wellington. Outside of work, you'll find Callan on your boat, so he loves a fish.
Yep.
What's the biggest fish you've ever caught?
Probably a marlin. Yep, striped marlin.
What are we talking? Don't be shy. You can boast.
We let it go, but estimate 100 kilos.
Oh, that's a fish, mate. Also says you're into a bit of snowboarding, and when you're not broken from that, a little bit of golf, and obviously you enjoy the same hole as me, which is the 19th. Best one to, it was actually my best hole. He's got a certification in addition to his qualifications in financial services. He's a regulated financial advisor, provides specialist mortgage advice. Callan, welcome to the podcast.
Thanks, Chip. Yeah, thanks for having us.
Not a problem at all, mate. Now, this is going to be a really, as I said, exciting episode. We're talking about the mortgage and financial industries, the sector. Already in 2024, I just want to ring off a few things. We're 6 months into this year, obviously, and a lot has happened. We've got, everyone's been watching the OCR, the official cash rate, obviously. It remains unchanged. We've got interest rates, which are a burning hot topic. We've got inflation still lingering around and people feeling the pinch of the cost of living more than ever. We've got amendments to the Triple CFA, interest deductibility write-offs. We've got new bright line tests for investors. And to top it off, a few weeks ago, we had the first budget, obviously from this new government, focused on tax cuts, came at the cost of job cuts and slashes to certain kickstart grants as well. Mate, I'm exhausted just talking about it. Should we call it there? Why don't we start with your observation? What's the first half of the year look like for you guys, and where are you guys seeing activity?
Yeah, there's a bit to unpack there.
Yeah.
There's yeah, when you put it like that, you don't really think about it. You just sort of carry on. But I think it's fair to say it's pretty tough. It's a tough market. The country's probably recovering from the sort of COVID hangover, if you like.
For sure.
2021 were once we got through COVID and realised that we were going to survive.
Yep.
Probably the country sort of went on a bit of a spending party, if you like, and
it's a great way to sum it up, isn't it?
That might have been a really big Saturday night, and then probably 2022 was probably your Sunday when you're good for nothing, and a number of houses probably sold half in Wellington almost.
Yep.
Number of sales. 2023 is probably Monday.
Yeah.
You're kind of back to work, but you're not quite there, and maybe 2024 is probably Tuesday, where you're sort of, still a little bit sluggish, but but you're getting back into it.
Listen, I love that analogy. I think about 95% of our audience will understand exactly what you're saying there. So let's talk about the OCR and let's talk about interest rates, because let's get straight into it. It's the topic everyone wants to know about. It's as I said, it's a hot topic. Let's start with this one. Crystal ball. What needs to happen for us to see interest rates drop? What do you think?
Yeah, I guess it is the hot topic, and you've got sort of two things at play really. You've got the Reserve Bank, whose own forecasting is that OCR won't be dropping until the latter part of next year.
Gotcha.
They're just trying to keep the foot on the throat of inflation to get it under control and not risk that inflation sort of carries on or becomes too embedded.
For sure.
And that's really playing its path. The wholesale markets, on the other hand, so what determines the rates that the banks are paying, the wholesale markets are factoring in or pricing in rate cuts from later this year.
Okay, that's interesting. Okay.
Yeah, so I think it's fair assumption that barring anything from way out of left field, that we're at a peak in interest rates.
Gotcha.
And the light at the end of the tunnel is, they should be coming down, and no one knows exactly, but it should be in the next 12 months.
Yep.
But we're doing it tough while we're at these sort of high rates.
Absolutely. I love what you've said there as well, though, that this. Well, I mean, most people are going to love hopefully what you're saying there, that this is the peak, and so obviously on the other side of this, we need to start preparing for what could be a little bit more of a favourable market to us. What cues do you listen for? I mean, you mentioned there in terms of the wholesale markets. What cues specifically do you listen to or suggest people out in the market should take note of when it comes to looking for these rate falls?
Well, there's a lot of economics behind it that a lot of people have no time for, really.
Sure.
And there's data coming out all the time that's in favour of a quicker reduction or a more laboured reduction, and really what the market's looking for is, get a bit technical, it's that third quarter inflation data.
Gotcha.
So
yep.
It's to the end of September. That'll come out in November.
Yep.
And that's really where markets think that the inflation story will be under control.
For sure.
And that's why markets are pricing in cuts earlier. So you probably won't expect too much before then.
Okay, yep.
But, things can change, but that's really what the market's kind of hanging out for.
For sure, yep. No, that makes complete sense. I want to talk to you a little bit around a bigger question as well. Given that what you've just said, what would your advice be to someone that's looking, maybe their loans come up or maybe they're getting in terms of fixing? Is it better to fix for a year, 18 months? What would your advice be around that?
Yeah, so sort of general.
Yeah, just general.
Not financial advice.
No, exactly. Full disclosure.
The most activity is 1 year. That's where the punters are landing on. But it's different for different people. Some people have maturity spread. Some people want to go a bit longer because the interest rates have stayed higher than initially expected.
For sure.
And they might be coming up now expecting that they would have had a lower rate and they haven't. So 12 months is probably the sweet spot, but
yep.
Maybe 18.
Gotcha. Yep. Nothing more than that, you don't think?
Not unless it's a really attractive rate, or you're in an individual circumstances where if you get it wrong, it's going to really hurt.
Yep.
So if you're just looking for pure value,
for sure.
That 12 months.
Let's get into inflation, because that's another topic that we just talked about, which is obviously hot on everyone's mind. And you mentioned as well third quarter inflation data, which is going to be a good measure in terms of where things are going. Is there any is it easing? Is what people want to know. Is there any trends or any data to suggest it's easing?
Yeah, it is, and it's sort of measured as a rolling average of the last 12 months. So the quarterly data it has dropped. So it's heading in the right direction. It's just the risk of not getting it right for the Reserve Bank is we're all going to suffer.
For sure.
So they're keeping the pressure on, and in a way they're incentivized to say, hey, no rate cuts, because if they say, look, we're going to plan to drop the rate this year, then people are going to go out and spend money.
Of course.
And that's going to be counterintuitive to what they're trying to achieve. So.
That makes complete sense. New government in. So obviously big election year last year, scraped in. Uncle Winnie came to the party again for the upteenth time. Have we seen anything in terms of the new government, I should say, having an impact in the short term on inflation?
I don't think anything sort of major. Obviously the budget has recently come out, and the government's got a pretty tough job.
What were your thoughts on the budget? Like you said, tough one for them. Obviously, a lot of tax cuts, which they campaigned on. Where they had to find those tax cuts is another matter. What are your thoughts in terms of the budget and going forward? And did you see anything in there that was specific to people that are going to be looking to take out a mortgage? Or
I think it was a pretty hard budget. Like you're trying to appeal to your voter base, and you're giving pretty modest tax cuts to arguably people who don't necessarily need it. But
sure.
Where you've got the sort of lower end of society really struggling with the cost of living. So, on the sort of home buyer front, or the first home buyers, which is a big part of our space, is the scrapping of the first home grant.
Yeah. Well, I'm glad you brought that up, because that's definitely a question. We put out a survey, and we're getting into it now. That was the one that was on everyone's mind. What's happening now? Maybe talk us through it.
Yeah. So first home grant, for those who are not familiar with it, you could potentially get $5,000 for an individual to buy your first house, or you could get $10,000 for a couple, or you could get double that if it was a new build. But there's a whole heap of rules that came with it, and the government scrapped it. And on the face of it, it looks like a negative, but I don't think it's going to have too much impact. And you can sort of break down the mechanics of it, and the key thing behind it is there's a product that's very similar called a first home loan.
Yep.
And it's a loan that's backed by the government that the banks can write, or some of the banks can write. And you can do that with a 5% deposit.
Gotcha. Okay, that's critical for people to know out there at the moment. So you can do that with a 5% deposit. Excellent.
Yeah, but only so many people qualify, so you can't earn too much.
Gotcha.
But you got to earn enough to get the loan approved. So it's a bit difficult. But in Wellington, for example, existing house, you can buy something no more than $750K.
Okay.
And if you are a couple, your income has to be under $150,000. Your gross income last 12 months. So, but to get the grant, you had to be in KiwiSaver for 5 years.
Gotcha.
To get the $5,000. So, but those people who qualify, so they earn under $150K in their house. The house is under $750. They have a 5% deposit in KiwiSaver by default, because if you're putting in your 3%, your employer matches it. You got 6%. And say your household was earning $150K, it might be a bit less. You're getting $9,000 a year into your KiwiSaver, plus the government $500 odd bucks, plus some investment returns, hopefully. So people have got the 5% deposit.
Yep.
It's probably actually harder for those who earn $151,000 or more.
Yeah, for sure.
They can't get that first home loan, so they probably sort of need the 10% deposit. So I kind of understand when the government's got to make some cuts. That those who could probably buy a house, even though they'd love that extra money, I can understand that they take that off. But as long as that loan's there, I think those first home buyers who qualify will still got a good pathway.
Excellent. Yep. And in terms of the logistics there of the pricing that you're saying, it's most likely that those first time home buyers are under that cap. 150, 700 is probably, in terms of what you're going to be able to purchase for a home, it's where the median house price certainly around the hut is. So, and that's a majority of our market, so it makes sense.
Yeah, the price cap used to be 500 or 550 or something, and just no one could get it.
Sure.
Like house prices back kind of 2020, 2021, so it was a fairly kind of, useless product, but now it actually fits a lot of people. And I think the people who need the help, struggling with a deposit, the income is enough to get a house, but it's not ridiculous where they should be able to do it without any support. So, as long as that product stays in place, and the terms are really good too.
I love that we're on the topic of first-time home buyers, because, as I said, it's definitely one of the groups of the market that we deal with the most, and it's always one of the ones that has the most amount of questions. Let's break it down into layman's terms. We'll make this as easy as possible. Let's say, for example, I'm the buyer. I'm the first-time home buyer. I have been saving up a bit of money. I'm looking at getting into my first home. Obviously, I've come to the great Callan after many recommendations and referrals to me. Mate, you're going to obviously talk me through an application, but what are the things I should be doing to get the best application together? What are the things the bank's going to be looking at? Maybe some of the red flags, things like that. Talk us through it.
Yeah, good question, Chip. So the like, I think the first thing is go talk to a mortgage broker.
For sure.
Because everyone's circumstances are slightly different, and a lot of people are a lot closer to being able to buy a house than what they may think. That's kind of what we find. But just sort of practical things, like the bank's going to look at your bank statements. They're going to do credit checks.
I think people just shudder just when they think about that.
It's not as bad at what it was.
For sure, yeah.
The banks used to scrape your statements and analyse all your spending, and you probably heard people getting declined because they, had too many coffees.
Oh, with Netflix, KFC, people came out with a lot of things. Yep.
Yeah. So I mean, if you have kind of tidier bank statements, you're probably going back 3 months typically. So
okay.
Sometimes you go back 6.
Yep.
One thing that is the buy now, pay laters.
Okay.
And I get it, interest free, it's easy. Just chuck it in on the website when you.
Oh, so this is things like Afterpay and gotcha. Yep.
Just get rid of them.
Yep, gotcha.
Like the way it's a square peg in a round hole how the banks assess
Gotcha.
your ability, because they've got to factor in that you're maxing these facilities out. So, get rid of them is really good. Keep your accounts tidy. Like, don't go overdrawn.
Yep.
If you got credit card limits that you don't need, dial them back if you can. Like, that's sort of probably the most of it, but definitely get some advice as well, because you might not have to do all of those things.
Yep.
And a mortgage advisor will be able to cut through that, let you know a budget. Do a budget, sort of know what's realistic for loan repayments, for your outgoings, and so on.
Well, I think that's absolutely great advice, isn't it? Because these are the things, like, number one, it can be very overwhelming and daunting when you're talking about people's private finances, you know what I mean? And like I said, when you think, because there was the whole statement scraping and, they put it through this and AI detects how much you spend, and, people kind of flutter when they think about that. But I think what you're saying is, look, if you can, get to a mortgage broker, sit down with them, and even just things like just coming up with a budget. I think, majority of people probably aren't that way inclined.
Yeah, and I think with cost of living too, like people get a bit of a shock sometimes doing a budget now, because what they thought was whatever $100 a month, it's 150, and
exactly.
I think just general living costs last 3 years gone about 20%.
Yeah, 100%. Yeah, no, I mean, look, we'll keep going, because it is a good talking point, because it was those triple CFA days when it was coming out in the media that, and look, the media always does what they do best. They probably blew it out of proportion in a few examples, but it sounds like the restrictions on that have been somewhat amended or lifted when it comes to the triple CFA.
Yeah. So the legislation was really not fit for purpose, and it put the onus on the banks to look at everything that you're spending money on, even if it was just discretionary spending, stuff that you'd cut back if you didn't have the sort of spare cash to do it. As a bit of a side note, John Bolton, who's the founder of Squirrel,
yes,
he actually started a petition because there's all the noise around it, nothing was being done, and he started a petition to get an amendment to the triple CFA.
That's right, I think I remember that. Yep.
He went to Parliament, got a meeting with the minister, got a review. IMBY did a review, and it's been reworded and that, so it's a lot more sort of pragmatic.
Gotcha.
And user friendly.
Yep.
But people are nervous.
Yes.
People come to you, and it's probably like maybe when I go to the doctor and I'm a little bit uncomfortable, talking about your health and stuff. And the doctor just probably doesn't really give it. They want to help you, but they don't really care.
No.
Whereas and I think that's a bit like us. Throw everything on the table. We kind of know how to put everything together. We know what works, what doesn't. There's obviously confidentiality is really important.
Of course.
Your information is only given to the bank with what they need to do their job. So, definitely encourage people to just throw it all out there.
Yeah.
And that'll give your mortgage broker, the more information they get, the more they can help you, the better advice you're going to get.
100%. And I think you hit the nail on the head before when we were talking, when you said, you're not really interested in what's in the statements. You're more interested and invested in helping them get the property.
Yeah, exactly.
Yeah.
It's all about the result. Like we probably get caught up in like the mechanics of processing a loan, which, to be honest, is relatively boring.
Yeah.
It's really what's in behind it is, helping people, buy their first home.
Yep.
It's an awesome achievement, and that's what really gets us excited.
100%.
That's why we're, a lot of us still doing it after all these years.
Yeah, absolutely.
If it was just like going through bank statements or something, we'd be out the back door.
Talk to me about the difference between, the different jobs and the different ways that, let's say, for example, the banks look at that. So if I was self-employed, for example, from running a business, what is the bank going to need from me for that in comparison to just kind of, someone that's out in the workforce?
Yeah, so self-employed, especially small business owners, they get a fairly hard time from the banks.
For sure.
And, we've all sort of seen it personally, but the key thing is having your financial accounts.
Yep.
So if you are planning on borrowing and you got through the tax year, get your financial accounts done as soon as you can.
Yep.
It's not the end of the world. Like, you can use accounting software, and each bank's slightly different as well. So that's where your mortgage advisor will be able to sort of cut through your situation and say, hey, this is what you need to do.
Yeah. Gotcha. Yep.
So ideally, if you have a bit of a lead in too, like you're not sort of under offer, you got finance to confirm tomorrow.
Yeah, of course.
All your receipts are sitting in a shoebox sort of in the office. But we're used to self-employed. It's a big part of what we do.
For sure. And in terms of is it with the financial accounts, is it 1 year, 2 years, 3 years, 5 years? What are they?
Yeah, bank to bank varies.
Yep.
And some banks are a lot more favourable than others. So the starting point, if you've got 2 years, then it's generally a lot easier. But we've helped start-up businesses. We've helped people with less than a year's trading, depending on the type of business and what they do.
For sure.
We help a lot of contractors in Wellington.
Yep.
So it's 2 years is nice.
Yep.
But we operate a lot outside of that.
Okay, cool. That's good to know because it's one of those. It is a hard part of the industry, being self-employed, running your own business.
Well, it's also doing that through the last sort of 4 years.
Oh my gosh, exactly.
With COVID and businesses were closed down, a lot of them. So. Yeah, and other businesses were doing really well. So it's kind of been able to sort of get the story behind the numbers and knowing how that fits in with the banks to kind of get the result. But we've sort of seen that one of the things that's happened with COVID, it's been happening slowly, is probably with the advancing of technology, and that is the bankers on the ground that the banks used to have are not there as much. So I think the mortgage brokers are coming in and filling that void.
Oh, this was another question that came into us as well, and it's obviously to do with the application process. What is means testing like in terms of, I suppose, that's interest rates, and how do the banks calculate, say, for example, affordability?
Yeah, so stress testing.
That's what I was, stress testing.
Yeah, so say you take a loan out today, you might be borrowing at a 6.6% rate or thereabouts, depending on how you structure it. So what the banks will do in the background when they assess your affordability is they apply what they call a sensitised rate.
Yep.
And at the moment, the banks are using around 9%.
Gotcha. So 9%. Wow.
Yeah.
Okay. Yep.
So when you've got high rates that hopefully are peaking, that 9% is quite a tough requirement.
Yep.
But what the bank wants to know if there's something adverse happened, interest rates did get to that level, that it's still going to be manageable.
You're still going to be able to manage your payments. Okay,
Yeah.
Excellent. Yep. What's competition like at the moment? Is it a competitive market out there with what they're offering? Or are most banks on a level playing field? Basically, are there any good deals out there at the moment for buyers?
Yeah, so it's, I think, whether it's sort of competitive, what you see is you got advertised rates, you got advertised specials, and you sort of got what the public can see.
Yep.
And then you've got the market.
Yep.
And so the market is what you can get.
For sure.
And often customers say, what's the advertised 1 year rate?
Yep.
Well, from ANZ, I was like, I've got no idea.
Yep.
But I know it's 685 is
Yep.
what you can get.
Yep.
And the banks are fairly similar in where they're pricing. Like some of the big banks, 1 year won't go below 699.
Yep.
And the cash contribution.
Gotcha. Yep.
That sort of varies a bit, but you're typically getting kind of 0.9% of the loan amount. So for every 100,000, it's $900.
Yep.
Or
and is it a cash back? As in once you've done the loan, they
Yep. Yeah. So take the loan out, you get the cash payment. The bank will tie you in with them for a few years.
Yep.
But that's really good for first home buyers because you've got your legal fees.
Yep.
You might have a valuation required, your building report signed.
Yep.
So, the cash is pretty welcome.
So if you're buying, for example, we were talking before, say 700,000 or under that cap for a first time home buyer, and working off, $900 per 100,000. I mean, that's almost close to 6,000 or 7,000 that you're getting back.
Yeah. So, 750 with 5% deposit, you're borrowing over 700k.
Yep.
6,400.
You're not gonna.
And you can get those special rates at the moment too from some of the banks. So you
Yep.
can get, even though you got a low deposit, which normally you pay a premium on the rate.
Yep.
Yeah, you can borrow 685 for 1 year.
Yep.
So it's pretty attractive.
So it's still competitive out in the marketplace amongst the banks.
Yeah, I think the banks have they've slowed down on new volume.
Yep.
The refinancing is where there's a lot of competition, and it's probably sort of been there, but the borrowers are far more receptive to it at the moment because you've got these people that have been fixing a number of years back and they're rolling off, and they've come from sort of 2-3% rates
For sure, yeah.
and they're going on to these rates in the sixes, and it's a significant increase in their repayments. So
100%.
So when someone was maybe rolling off a 5% going down to a 4%, they're just like happy days.
Yep.
Just hit the app on the bank and,
Yep.
and away you go, lock it in. It's like wanting to review your Powerball. You just don't want to deal with it. But so make it easy. Whereas now they're like, my payment's going up $600 a fortnight.
Yep.
Where am I going to find that from? I'm going to have to make some changes. How can I sort of do the best that I've got? So these cash payments to move banks is a big sort of focus at the moment for a
And
lot of people.
incentive, I can imagine, for those people that are switching around.
Yeah, well worth the effort of going through and switching banks.
What's your advice when it comes to negotiating with the bank? Like, do you guys do the negotiating on behalf of a buyer?
Yeah, a lot of people aren't that clear about what we do, and they
Yep.
sort of think they come and see us and we say, oh, you can buy a house, and they're like,
Yep.
all right, do I go off to the bank and do it? It's like, no, we do all of that.
For sure.
Facilitate the approval and negotiate the rates. It's probably a benefit of Squirrel is we're a reasonable size outfit. Like
For sure.
we're sort of targeting about $3 billion in lending this year.
Ooh, mate.
And that's getting up to what some banks are writing through their own channels.
Yeah.
But with that volume, you've got good relationships
Yep.
and you've got really good visibility. So
Gotcha.
we track all the pricing. Like, we know where the market's at. We know that what we can get because we've got
100%.
all the other customers we're getting it for. So we don't. You used to kind of push for a rate and you get it,
Yep.
and then you're like, right, I know I can squeeze another
Yeah.
0.1 or a 0.2 or something. You push back and you have this email trail. Now it's pretty much cut to the chase, best pricing.
Yep.
And the banks know that if the advisor's going to do the best thing by their client. So if they're not going to come to the party, then they're going to be up against other offers, which
100%.
which would be could be better.
Which is, again, that competitive marketplace, isn't it? Okay, I want to talk about investors. We've covered off the first-time home buyers. Another very important part or piece of the puzzle in the current market. I'll just hit you with the real quick one. Are you starting to see any investors come back into the market? Because I know for a couple of years there, it was kind of like a ghost town.
Yeah, not in your sort of traditional mum and dad investors.
sure.
And by your mum and dad investors, you're talking about people who maybe had their existing house for a while and they've got relatively low debt. They've got the equity to go buy a rental property. They're not hands-on. They just want to set and forget. And right now, they're still not really coming back, despite a lot of the changes you mentioned at the start.
Yep.
And the numbers are just not quite there. Like, if you're borrowing sort of close to 7%,
Yes, yep.
and rental property yields, or the rental return might be sort of 4 or 5% of the value on a standard place, you sort of got to fund that 2 to 3%.
For sure.
And then you got rates and insurance.
Yep.
And at the moment, when you combine cost of living, people's spare change is just evaporating. So I think that the time will come, because it's a cycle, and you've got rising rents, you've hopefully got interest rate relief, and you've got a lot of people sort of on the sidelines. But the investors that we're seeing at the moment are probably more back to your sort of traditional market where people buy something and add some value.
Gotcha.
So
Okay.
you do up, you sort of subdivide
Interesting. Okay.
subdivide the section and build.
Yep.
there's a few sort of looking for distressed sales.
Yep.
So there's always those buyers who want to take advantage.
Yep.
The other investors that we're seeing are sort of not by default, but it's upgraders.
Gotcha. Yep.
So people who want to go to their next house,
Yep.
they're taking advantage of a softer market in terms of buying their next house, but they don't want to be on the other side of that soft market by selling their existing. And they think, right, I'm just going to rent it for a year or two. Logistics are so much easier.
Yep.
My position is strong enough to have the finance
For sure.
across both properties, and we'll rent it out and review things down the track.
Gotcha.
So that's sort of what we're seeing mainly on the investment side.
What are the current LVRs for investors now? So is it a 40% deposit still? Or
Yeah, good question. So it's changed around a lot. It's existing house, it's 35 right today.
Okay.
But it's changing to 30.
Oh, okay. Yeah.
So part of these debt to income regulations, which has kind of got nothing to do with it, but it's come out by the Reserve Bank at the same time, 1st of July,
Yes.
you only need 30% on an existing property if it's a rental. So a little bit easier. It's,
Yep.
5%. It's just a small change, I think.
Okay.
That'll make things a bit easier, yeah.
Is there any benefit, because this is another question that we had as well, Wellington especially, we've seen a lot of development of new properties going on in the marketplace over the last 3 or 4 years. And certainly we've seen, now a lot of options in terms of new builds.
Yes.
Obviously, we talked about the first-time home grants and getting rid of that, but is there any incentive for buyers out in the marketplace to be looking at new builds and trying to, promote that side of the industry or company?
Yeah, so they're exempt under those LVR rules. So,
Gotcha.
So basically, you can go higher, and it'll just depend on what the bank's appetite to do that is. So you can, like in theory, you can do 10% deposit or 10% equity against your home and settle an investment new build.
Yep.
A lot of people do it with 20.
Gotcha.
Because kind of if you're borrowing the remaining 80%, that's sort of your sweet spot to get the best terms out of the bank. So new builds are definitely still attractive in terms of your ability to have the equity to do them.
Yep.
For an existing house, which might be out of reach for an investor otherwise.
Gotcha. Yep.
Yeah.
And what about in terms of the bank's perception when, say, for example, it's an off-the-plan sale, so obviously there's a bit of risk there given the current climate of the marketplace, the developer's going to go under or this or that, the other thing. Do the banks look at the reputation of the developer or take into consideration what they've done in the marketplace, or is it more just on a case-by-case basis?
Yeah, if it's off plans and the completion is more than a year away,
Yep.
You might get an approval, but it's really not binding.
Gotcha.
So that's the risk that people, and the reward for hopefully some capital gain. But the banks are more like get the thing complete.
Yep.
Get code of compliance, get title issued.
Yep.
And then the development's done. So the development risk doesn't sit on the buyer because if that's not met, they can walk away.
Gotcha.
Yeah, it's been an interesting space over the last few years.
Absolutely.
With the way the market's gone, and definitely people who were in a really strong position signing up come to settle them almost 2 or 3 years later. There has been challenges getting finance.
For sure. Yeah. I think what we're seeing in the marketplace now is also a lot of the developers that have been able to stay in the game. Now that they've got construction, now that they've got the means to be able to get these properties completed, and now, as you were saying, on the completion side of things, brand new builds, obviously, never been lived in, CCC, all of that stuff. So that's when people should be going in and having a look now out in the marketplace.
Yeah,
options.
Yeah, and also if it's just for a first home buyer buying a new build, is some of the banks will offer some special carrots in there with discounted interest rates and so on. So new builds are good from the bank's point of view from a security perspective, particularly if they're completed, they're signed off, they've got no maintenance. Compared to an existing house where they're going to be going through all your sort of disclosures.
Of course, yeah.
Any defects. Generally easier to insure and so on. So, the banks don't have a problem with new builds. They like them, but the challenge is there's a real disconnect between how the developers get funded based on pre-sales.
Gotcha.
Where the bank, which could be the same bank as the purchasers buying their sort of investment property off, is the same bank won't give a binding approval to that purchaser.
Gotcha. Yeah.
And regulations get in the way of them doing that because they don't know the position that purchaser may be in if it's a couple of years down the track.
Sure. Yeah. That makes sense.
It would be a lot better if the purchaser maybe for some sort of fee or something, they have a committed approval from that bank.
Gotcha.
To know, hey, they're behind them. Maybe if they lost their job or something, they could settle the loan, but they might have to have a plan to sell it or get a job or something like that.
For sure. Yeah, that makes sense. Yeah, definitely. Refinancing. Okay, so we've mentioned that word a few times. Layman's terms, what does it mean? What does refinancing mean? And when do people do it?
Yeah, so sort of industry refinancing means switching banks.
Gotcha.
People might restructure their existing lending but not necessarily move banks.
Yep.
And people should regularly review. Like it's probably, when you buy a house, you're all excited, you're really invested in the loan, you're really invested in the loan structure. But once you've been living in it for a while and it's up for review, it just becomes a chore. It's like me, when did I last review my power bill? I couldn't think of anything worse. Yeah. And, but people's situation changes.
Yep.
Obviously, interest rates have changed massively. People should be reviewing their finances and their lending and reach out to a mortgage broker, find out what your options are, whether that is worthwhile to move banks or not. Just get some good advice and make sure you're sort of well positioned for where you are now, which might be quite a bit different from when you last did it.
Absolutely. So if I'm buying my house, as you said, I'm all jacked up, I'm excited, I've fixed for a year or 18 months or whatever we talked about, is that when you coming up to that's when you suggest, hey, now's the time to have a look at your options, what's out there. If you don't, does it just roll over? Like you keep paying the same, or does it go onto a variable? Or?
Yeah, so if you just have one loan, you fix it for a year, for example. Year comes up, if you do nothing, it goes onto a floating rate. Gotcha. So at the moment, that's quite higher than fixed. What most people do is and the banks usually try and make it easy to do it through an app, is you refix. But you might want to reach out and get some advice on how long to fix for example. But the big thing around refinancing, which is basically putting your business up for tender, your home loan up for tender, and that's when you're outside of a cash agreement. So when you set up with the bank and you talked about, the 6,000 or whatever cash agreement, the bank will lock you in for 3 years, sometimes 4 years. So
regardless of what the term on the rate is,
correct.
You've still got to be locked in there if you want the cash back. Gotcha.
Correct. Yeah. So people are switching onto this, and refinancing's never been a massive thing, and it's probably why the banks deal with it the way they do. Is now if you're outside your cash agreement and you refix with your existing bank, you're typically you should get a reasonable rate, but no cash.
Yeah, gotcha.
Sometimes the bank may give you a small retention payment, but if you go to another bank, they'll open the doors. They'll offer you that 0.9%. You get their sort of $6,000 or relative to your loan amount, and those are big numbers.
Gotcha. Yeah. So that cashback, that's not just for if you're taking out new business. That's for people that are refinancing and maybe jumping a bank as well.
Correct.
Gotcha.
Yeah, because it's treated as new business to that new bank.
Gotcha. Okay.
So they'll treat you like you were buying that house.
Look, it's no secret at the moment. We've mentioned that people are really feeling the pinch. It's not just at the pump. It's not just at the grocery store. And then we've got obviously the job cuts that have come with it as well. What should people be doing at the moment to ensure that if they go from, say, for example, they're coming off that 3%, they're getting ready, we've talked about the refinancing coming up, they're going to come to talk to you. If they want to get a lead into that, like what are some of the things that they should be doing now, today?
Yeah, so if you've got a rate coming up, it's probably good to review it 2 or 3 months out.
Gotcha.
Just so you know what your options are. If you were on the low rates, like when rates were getting down to sort of 2%, hopefully you were on a higher repayment than the minimum.
Gotcha.
And that would have effectively put you ahead of your repayment plan. And if you've done that, you can then sort of use some of that sort of credit, if you like, to not have the full brunt of these interest rate increases, so you can sort of stick to your original loan term.
100%.
But it's pretty brutal. Like if you're on a 30-year loan term, and you got to make it work.
Yeah,
and,
for sure.
But I think you just got to be proactive. You got to know, like if there's a shortfall in your budget, you got to look at how you can cut costs, how you can increase income.
Yep.
I mean, a lot of people, while the costs have gone up a lot, particularly in the early stages of this inflation cycle, as incomes were going up a lot too.
Yeah.
So you've sort of ridden both sides of it, and there's definitely stress out there, but like we haven't, you guys aren't flooded with mortgagees. So,
No, that was another question that I was going to ask as well. I mean, in terms of the mortgagee side of things, because a lot of people are comparing this market to the GFC and previous recession cycles as well. But it feels like even after the 2 years since November 2021, I mean, we're still, as a real estate company, we're still turning over volume. There's still buyers out there. Yes, prices have fell back, but to be fair, they've only fallen back to really a level where we were at 2019, which was before everything went kind of crazy. So is there a feeling like on your side of the market that people are maintaining at a better rate? I mean, you were around probably with the banks 12 years ago when we were coming out the other side of that. Is it different for you, what you've seen? Yeah,
I think what people have got to realise is between, I think it was 2017, 18 to the prices peaked, end of 21?
Yes.
As house prices basically doubled in Wellington.
Yep.
And that's not normal. Like, that is phenomenal growth. And the growth's kind of accelerated too. Like that sort of 2020, 2021 were the big years.
It ramped up,
And it might have come back, what was it, 25% maybe? I think
it was 25 to 30, that's what they were saying,
Yeah. It's and so it's hard to sort of compare to how things were in 2020, 2021. I think it's things should get back to more of a normal kind of market. But like if you're a first home buyer now and you've got job security,
yes,
you're in a position you can get the finance,
yes,
now's a great time to buy.
Yeah,
like you just need to talk to people who were trying to buy their first home in 2020, 2021.
Yeah,
and,
terrible.
Like we have people who would miss out on 10 properties.
Yeah,
they'd start with a budget, and by the time they brought, they would have added probably 20%.
Yeah, 100%. Yeah.
And you got to feel for some people who brought sort of near that peak. But right at the moment, if you see a house you like, you have got a lot better chance of getting that house.
Absolutely.
And you've got time to do your due diligence.
Yep.
And if you can make everything work now when rates should be at their peak, and particularly if you're young, you've got good progression in your career and your income, you got good job security, then things will get better.
Yeah, for sure.
And everyone's got an opinion around house prices and all of that. But at some point things will change, and no one really knows exactly when.
Yeah.
But if you're buying a house and you want a home for your family for the next sort of 10 plus years, get it, and you're in the position, and you can get the right house, and you can do it without competition. It's a far more manageable experience to do it now.
Yeah.
And then to potentially wait when everyone's trying to get back on, because there's all this pent up demand because people are sitting on their hands.
Yeah.
And as soon as the market's going up on the newspaper, everyone will be in there, and you're kind of going to be back fighting for it.
Yeah. Look, I think that you've just nailed that. That's an incredibly important point, and something that's very relevant with our side of the industry as well, because we were in those, we were the ones selling those homes in 2020, 2021. And, you look at the Hutt Valley, for example, Lower Hutt, Wellington. I mean, our stock in Lower Hutt got down to about 120 properties that were available on the market. You had a huge influx of buyers coming in because of those cheap rates. Money was cheap, which skyrocketed those prices, put them, through the roof. We had same situation, what you were saying. You would take something to tender. There's 20 tenders. The top three that missed out, they've put tenders on 5 other properties. It was just a vicious, savage cycle. And as you said, now, if you're in the ability, like to go out into marketplace at the moment, the stocks and same stock level, if you look at Lower Hutt, is up to 465 at the moment. Mm-hmm. So we've definitely got a lot more opportunity on the market for buyers. There's less competition out there because, as you said, people are sitting on their hands. Yes, the interest rates are high, but if they are at a level where they have peaked, as you're saying, well, everything from now, trajectory-wise, is going to be more beneficial for you if you jump on that gravy train and buy now.
Yeah, like there's a lot of noise about the government restructuring in Wellington.
Yes.
And the impact that has on the economy. And if you look at the numbers, there's I've read that about 30% of Wellingtonian workforce is connected to government. But if you strip it back, only a third of that, or say 10% of the total, is like government agencies, kind of the ones that are going through the restructures, and then they're restructuring. They're asked to make sort of around about 7% cuts.
Yep.
And there's definitely going to be people who lose their job, and that's going to be, unfortunate. But the actual numbers are not huge. It's probably more all the ones going through that process who don't know if they'll lose their job or not. Because most people will keep their jobs, and those will find other jobs. But buying a property or any big investment decision is about confidence.
Yes.
And when confidence is down because the story or the narrative is negative, people won't make those big decisions like buying a house. And you're not if you're going to think, is my job secure?
Yep.
But those government restructuring, from what I'm hearing, is a lot of that will be done in the next couple of months.
Gotcha.
And people will know, like, right, I've got through that, and I think there'll be a bit more positivity that will flow through. Yeah,
that's a great point. It's a great point as well. And I think you're right. I think it really showcases how much pull the media has when it comes to the real estate market. And you've nailed it. I mean, we could be sitting here in 12 months' time under a very, very different economy or a very, very different situation with inflation and rates and what have you. And all it takes is for the majors, in terms of the papers and the broadcasters, to start saying, the market, and like you said, everyone's going to jump on, and then all of a sudden force competition. And so it really is a cycle, when you're looking at it.
Yeah, and all the building that went on in Lower Hutt that then had a bit of an oversupply, or the market turned, is not enough new stuff's kicking off. So it's cyclical.
One of the other things that it was a question that came into us was around net migration. And obviously there's figures that have been coming in that showcase there's a lot of Kiwis jumping back over the ditch. I think there's something like 50,000 or something they recorded.
Off to Aussie, yeah.
Yeah, off to Aussie. But we've also got an increase in foreign net migration as well. How much of an impact does that have on the marketplace when it comes to determining these factors?
Yeah, well, it's supply and demand.
Yep.
And, there's a lot of talk around just what we talked about before is underinvestment in new builds.
Yep.
And I'm not sort of privy to the data around how much of that migration lands in Wellington. Definitely some of it, and we deal with migrants who've come here wanting to buy a house. But I think the bulk of it's Auckland. The bulk of it come from big cities and want to live in big cities.
Gotcha.
And Wellington's only a small city, and we probably want to keep it like that. But,
we do want to keep it like that.
But I think it is something that's going to get a lot of attention is the migration, the volume, the quality, and do we have the infrastructure to cope with it?
For sure.
It's going to put strain on housing and all of the other infrastructure, which is going to be a big problem for the government, for all of us probably over the next sort of 20 years.
So would you say that kind of flow on effect? Yeah, I mean it's futuristic or future planning, isn't it? Because we could, as we were just saying before, with a lot of that net migration coming in from foreigners, more competition in the marketplace, which means again if the market does start to shift, then you're up against how many people when it comes to buying a house. And as you said, we are under resourced in regards to new properties being built and what have you. So it certainly does have, obviously, an impact, something to think about in the future. All right, here it is, because we've got 5 minutes left. It's the crystal ball time. It's the Callan time. How long have you been in the industry? It said 12 years, but that was in the banking industry, and then another 10. So we're talking like 22 years? Does that sound about right?
Yeah, I think it's 12th year mortgage brokering.
Yep.
And I think it was similar in ANZ, but started young.
That's crazy. How old?
How old now?
No, I'm not going to get rude. How old were you when you started?
Well, I was at uni. I got a job in ANZ. I did a few different jobs in ANZ. I was actually going to be an accountant, so that's the accounting degree you referred to. So, but I got stuck in banking. I really enjoyed it, and basically never left. So, yeah, it's been a few years.
Yeah, for sure. Let's go crystal ball. Let's talk the next 12 months. What does Callan think is going to happen? Where do you think that we're going to be in the next year, and what are the big changes that you think that we might be seeing? Full disclosure, this is not any financial advice.
Yeah.
You don't have to move on
Yeah.
it. This is purely opinionated and editorial.
Opinion. Well, they say opinions are like arseholes. Everyone has one. But,
Okay.
definitely not financial advice. Well, I think the economy, it's going to be challenging.
Yep.
Like, I think we will probably start using the word new normal.
Gotcha.
But it'll carry on. Like, people need to trade houses. It's your most important sort of asset. People want a home. In terms of house prices, a lot of economists were predicting growth this year.
Yep.
And 5-10% house price growth across the country, and it's a bit patchy across different regions. So, I think it's going to be pretty modest if I just took a stab at it. But the interest rates story will have a massive impact. So, we kind of say the cost of a house is not so much the price you pay for the house; it's the price you pay for the servicing the debt on the house.
Yeah.
And say rates around 7% at the moment. If they go down to 5%, which would be more of a kind of an equilibrium, sort of space if we had sort of a neutral inflation outlook, within the Reserve Bank's kind of target, then basically you're looking at a 20% swing in either how much you can borrow on the same repayment, or so someone borrowing 600k could borrow 750k.
Wow, yeah, that's a massive jump when you think of it like that. Yeah, and only kind of like a 2 to 3% decrease in the rate.
Yeah, so quite sensitive dynamic between interest rates and house prices, and I would be watching that interest rate path. So, if we see rate, and it might take a while for rates to come back down to more lower levels. We won't see the sort of 2%, 3% unless we have something catastrophic. But, if you looked at a sort of a long-term rate, will we get around 5% perhaps? That's going to be a pressure on house prices if we have that supply and demand imbalance. So when that happens, it will all depend on the timing. It's pushed out a bit. The job is nearly done on inflation. Keep tabs on where that's tracking. And, but it looks like 2025 will be a bit more positive when we see interest rate relief.
Excellent. Well, I'm sure many people that are listening are hoping that your predictions come true there, mate. And finally, mate, Squirrel Mortgages, so formerly Home Loan Shop. Talk to us about it. How's it been? Because you guys have obviously rebranded now. How's it all going?
Yeah, Home Loan Shop, we were coming up probably 25 years ago.
Wow.
It started, and then I came on board 11 or so years ago with Mark Cook, with Cookie. He's you guys know really well.
Shout outs to Cookie. Yeah, we know him very well. He sent me 15 questions today.
I wouldn't have joined it if it wasn't for him. But yeah, so he and I set up in Lower Hart, Queen's Drive. You guys were across the road.
We were indeed. That was our first office, was? Absolutely.
I think you just set up only probably a few months before us. And I mean, we were already getting your second-hand furniture and setting up our office on the smell of an oily rag.
That's exactly what we did, mate. Absolutely.
And so yeah, we had a good relationship with Ray White. And but anyway, so we were just carrying on, and we kind of grew a lot, not necessarily deliberately, but just by trying to do a good job, really. And we got bigger, and then Squirrel were primarily Auckland based, and they had grown actually a lot more than us, and they were really better positioned to keep the growth going. And we really admired how they operated, what their values were, and I think there's a bit of a mutual sort of a bromance there, and we just sort of come together. We'd be better together, and so a couple of years ago we actually did the sort of kind of corporate side of the merger, but we just operated as a home loan shop, just to kind of to take it easy in terms of slowly bringing things together, and we rebranded start of this year. But we've been so it's sort of coming up a couple of years, and it's kind of different, but it's kind of the same. Our team's the same. We had 6 shareholders at the time. We're all still here. We just wanted to have a bigger ability to help customers when you really boil it down. And and together we've sort of been better. So Squirrel are a lot more in the media, like this stuff.
Yep.
I'd never do this stuff.
We got you though.
You're a good salesman.
We got you though.
World
famous in lower heart.
But they advocate for the borrower, for the sort of layman. They're submitting on all the policy changes.
Yeah, as you mentioned,
They're really well connected. Really good, marketing and sort of back office support and all of that. So, it's so far it's been pretty smooth.
Yeah, for sure. Yeah. And what about you at the moment? I mean, obviously a long career in this position. Are you taking on new clients? Is that always something that you're doing? If people listen to this and they say, "Oh my God, this is the guy I need to get my mortgage with."
Yeah, for sure. So I've never been the biggest writer. Like industry wide, we do some pretty good numbers, but always sort of trying to work on the business as well. And, and we've got a really good team.
Yeah.
So we've got about 20 of us on the ground in Wellington, and we've got some real young, energetic,
absolutely
good advisors in our team.
Shout out to Geordie Mitchell, one of those really energetic people.
Yeah, for sure. But no, I definitely taking on clients or amongst the team, like definitely we're here to help.
Well, mate, that's been, I could sit down and talk to you all day about this because I think it's just so relevant at the moment. And I think it's incredibly interesting. We've nailed some really good points there today. And I hope that if anyone is listening at the moment, probably the biggest and most key takeaway when it comes to your financing, your mortgages, whether it's first time investing, refinancing, what have you, is go and talk to a broker. Because as you said, Callan, that's the best way to be able to just get your ducks in a row if we want to, use layman's terms.
Yeah, like there's some people sort of think, oh, what's the catch and all that. It's kind of like, why wouldn't you? It's there's no secret.
Yeah.
Like we basically do the job that the bank would do, and they pay our company for it. It doesn't cost you anything.
Yeah.
You're not tied in. It's I think brokers generally really want to help people. So. If you've got any kind of sort of questions around, just ask.
Yeah,
just ask. Like,
absolutely.
But I say to people, hey, there's no secrets. We're just if you can get someone who hopefully kind of knows what they're doing.
Yeah.
Cut through the sort of red tape and get you the result. Give you some good advice, and it's a bit of a no-brainer.
100%. And I think you've nailed it on the head, mate. It's like any industry, you're going to have some that they fall under the standards and expectations. But I know for a fact, having worked with you and the crew at Squirrel, formerly Home Loan Shop, that you are the absolute best in the biz. That was amazing, Callan. Thank you so much for joining us today.
Thanks, Chip. Yeah, thanks for having us.
You are most welcome. And as we say in the industry, when it's all said and done, we are going, gone.